5% bond yields may be spooking markets, but my next guest says we shouldn't be so alarmed. They're just reverting back to the historical mean, along with inflation, taxes, and nominal GDP. Joining me now is Jason Trennert, Chairman and CEO of Strategas Research Partners, a Baird company. Also with us is Brian Weinstein, Head of Global Markets at Morgan Stanley Investment Management. It's great to have you both here this afternoon. Jason, I'll start with you. You think this is normal. This is normal. Everything's fine. Stop panicking, everybody.
Yeah, I think that's my view. I think what was not normal was the Fed fixing interest rates, the most important price in the world, for 12 years. And I think the problem now, I think generationally, and maybe I could say this because I'm maybe a bit older, but I think people have forgotten that there's, normally people who lend other people money require some premium over the rate of inflation to do so. And we all got very accustomed to the fact that real rates were zero or negative in some cases. And so I think to the extent to which the Fed is unlikely to use quantitative easing again soon, I hope, that would mean that there'll be a typical spread of about 200 basis points between the rate of inflation and the 10-year Treasury. I also think that there are structural reasons why inflation is likely to stay higher than the 0 to 2% range we became accustomed to as well.
Let me ask both of you, just to be clear. So do you think that 5% yields, you can pick the 10, the 30, whatever. But I mean, on the long end, Jason, is that basically the top, or do you think they could head higher from here?
What worries me, Kelly, is that there is just a certain amount of fiscal incontinence in Washington, D.C. We're running deficits that are 5% of GDP at full employment. So the amount of issuance that we're going to see just on interest expense alone is going to explode. So normally this would be enough. I would say this would be in the range of kind of the upper end of the range. The issue is that there's absolutely no discipline on spending or deficits, which means that the supply of treasuries could explode.
So all that said, Brian, let me ask you kind of a simple question first. If you think 5% is the top of the range.
Kelly, I agree with a lot of what Jason said. There's no reason to believe that 5% is magical. And to add to what he said, in the long end, when I started, if we're telling more stories, we had a balanced budget, right? There are going to be no more there are going to be no more treasuries.
Right.
10's bonds curve was inverted. Now we have infinite deficits, and 10's bonds curves is almost flat. The long end of the yield curve is not cheap. The rest of it is cheaper. It may not be the top, but the long bond has some work to do, I think, still to find the top of a range.